This video is for informational purposes only and is not financial advice. Consult a licensed professional before making financial decisions. Invest at your own risk.
Look, if your money is just sitting in a savings account, you're actually losing money. Inflation is eating away at it every single day. But here's the thing, investing isn't just for the rich. It's not complicated, and you don't need thousands or tens of thousands of dollars to start. Stick with me, give me a few minutes of your time, and I'll show you exactly how to make your first investment today. I get it, investing can feel overwhelming. There's a ton of internet advice on what you should be investing in, a million different options, and you see people promising you 2x, 5x, 10x in your returns overnight. And it seems risky, right? But here's what you need to know. Leaving your money in a savings account or in cash means it's losing value day by day. Investing is how you make your money work for you instead of just sitting there, using the power of compound growth. The earlier you start, the more time your money has to work for you. It's not about getting rich overnight. It's about building wealth over time. So how did I manage to grow my investments by over $10,000 since starting in 2022? It wasn't luck or genius stock picking. It was about the mindset and the habits. Here are the resources and strategies that helped me the most. Number 1, learn from the best and keep it simple. Bogleheads philosophy. I spent time in communities like the Bogleheads subreddit. Their core philosophy really shaped my approach. Their idea: keep investing simple, low cost, diversified, and stay the course for a long period of time. It's all about steady and reliable growth. Key books that changed the way that I think are The Psychology of Money by Morgan Housel. This book taught me that investing is more about behavior than intelligence. How you handle money matters more than what you know. The Simple Path to Wealth by J.L. Collins. A must-read book. It opened my eyes to the power and simplicity of index fund investing. The Millionaire Next Door by Thomas J. Stanley and William D. Danko. This book showed me that most millionaires build wealth through discipline and consistent saving/investing, not through high incomes. Number 2, make good habits easy and bad habits hard. Automate your success. The best decision I ever made was setting up automatic deposits from my bank to Fidelity and scheduling automatic investments into my Roth IRA every month. It's completely hands-off. I don't have to think about it, and it's more of a set it and forget it, ensuring that I stay consistent. Make spending harder. Take a hard look where your money is leaking, or for me, this was subscriptions that I didn't really use or there were alternatives to using them. I made sure that I turned off auto-renewers and made renewing subscriptions intentional and canceled pretty much everything that was unnecessary. Making it slightly harder to spend money freed it up for investing, which really adds up. By automating smart decisions and focusing on long-term consistency, inspired by these resources that I listed above, I found the secret sauce to building wealth. It's all about discipline and making good habits easy. So now we're going to get into the actual heart of this video, which is getting started investing and how to invest today. So you're going to choose your broker and account type. You need an investment account, often called a brokerage account. We'll use Fidelity for the purposes of this walkthrough because it's user-friendly, offers no-fee accounts, and many commission-free investments. It is important to note, while we're using Fidelity today, it's not necessarily better than any other no-fee brokers, like Vanguard or Charles Schwab, for example. The key is choosing a reputable firm with low costs and the investments you want. An account recommendation I have for 90% of the people watching, especially if you're just starting out investing, is a Roth IRA. Why, you might ask? Your money grows tax-free, and qualified withdrawals and retirement are also tax-free. It's a powerful tool. You can open one directly at Fidelity. There's a link in the description along with a walkthrough at Fidelity on how to open up that account. You can also open up a standard brokerage account, which is more flexible and allows you to access your money before retirement, or a cash management account for saving and spending. But prioritize that Roth IRA for long-term tax-free growth. Now that you have your account approved, which is usually quick, you need to put money into it, of course, to invest. Look for options like transfer on the Fidelity website or app, and you'll need to link your bank account using your routing and account number from your bank. To make an electronic funds transfer or EFT, enter the amount you want to transfer. Fidelity often makes funds available for trading in about 2 to 5 or business days. In my experience, it's usually pretty quick. This is the part that would take the longest in this tutorial. Okay, money's in the account, time to invest. Log into Fidelity and look towards the top left corner of your screen. You should see a trade button. Click it, a trade ticket window will pop up. It will ask for a symbol. This is the ticker symbol for the investment. My personal recommendation for beginners is a low-cost S&P 500 index fund. For me, this would be FXAIX. This is a mutual fund. This is Fidelity's 500 index funds. It holds pieces of the 500 largest United States companies. It's a large cap weighted index fund. It's giving you instant diversification at a super low cost. Make sure you select the correct account, your Roth IRA, choose the buy, enter the dollar amount you want to invest. With mutual funds like FXAIX, you invest by the dollar amount, not by number of shares. You can invest as little as $1 and review your order, check the symbol, FXAIX, the account and the dollar amount, and then lastly click place order. Trades for mutual funds like FXAIX execute once per day after the market closes at a price called the net asset value. The reason I recommend mutual funds over ETFs for beginner users is because I don't want you to get too worked up about the buy-ask spreads or whether or not you're entering the market at a good time, which is a problem that I faced when I first started investing. A common saying when it comes to investing is the best time to start investing was yesterday. The next best time is right now. The earlier you start, the more time your money has to grow, thanks to the power of compound interest. Let's break it down. If you invest $55 a week starting at the age 21 and earn an 8% on average return, by 65 you'll have over $1 million. Your total contributions? $125,000. That's nearly $900,000 in growth just from starting early. But if you wait until 30 to start, you'd only have about $500,000. Your total contributions would be $100,000 and your growth would only be roughly $400,000. That's over $500,000 lost just by delaying. Time is your biggest advantage. Don't waste it. And that's it. Investing isn't some secret club. It's something anyone can do. If this helps you, hit that like button and subscribe for more. And let me know in the comments, what's something you're investing for? Or what's the reason you're investing for? All right, everyone. Thanks for watching and happy investing.